Imagine growing your wealth to six figures, maybe even $1 million, without ever picking a single stock. Sounds like a fantasy, right? But what if I told you there's a simple, low-cost investment strategy that has outperformed most professional money managers for decades, and it's available to anyone, even if you're starting with just a few dollars? This isn't some get-rich-quick scheme. It's a proven method championed by legendary investors like Warren Buffett. We're talking about index funds, and they could be the most powerful tool in your financial arsenal, especially if you're a complete beginner. Stick around, because by the end of this video, you'll understand exactly how they work and how you can start using them to build serious wealth. So what exactly is an index fund? Think of it like a giant basket holding a tiny piece of many different companies all at once. Instead of buying shares of Apple or Google individually, an index fund buys a slice of hundreds or even thousands of companies that make up a specific market index, like the S&P 500. The S&P 500 tracks the performance of the 500 largest publicly traded companies in the U.S. When you invest in an S&P 500 index fund, you're essentially owning a small piece of all those 500 companies. This gives you instant diversification, spreading your risk across many different businesses and industries. But how does this diversification actually protect your money? Index funds work by passively tracking a market index. There's no expensive fund manager trying to guess which stocks will go up or down. Instead, the fund simply buys and holds the stocks in the same proportion as the index it tracks. For example, if Apple makes up 7% of the S&P 500, an S&P 500 index fund will allocate roughly 7% of its assets to Apple stock. This passive approach is key to their low costs. Since there's less active management, the fees, known as expense ratios, are dramatically lower than actively managed mutual funds. These low fees are a huge advantage, as even small differences in fees can cost you tens of thousands of dollars over a lifetime of investing. We'll show you exactly how much in a moment. Let's crunch some numbers to see how fees impact your returns. Imagine you invest $500 per month for 30 years, earning an average annual return of 7%. With an index fund charging a tiny 0.05% expense ratio, your investment could grow to approximately $605,000. Now, consider an actively managed mutual fund that charges a seemingly small 1% expense ratio. Over the same period, with the same returns, that 1% fee would reduce your final balance to around $517,000. That's a difference of $88,000, simply due to fees. This isn't just theory. It's why Vanguard, a leader in index funds, emphasizes low costs. High fees are a silent killer of your long-term wealth. But there's an even bigger myth about investing that keeps many beginners from getting started. One of the biggest myths about investing is that you need to be a stock-picking genius or have a crystal ball to succeed. Many people believe they need to research individual companies, time the market, and constantly buy and sell stocks to make money. This couldn't be further from the truth, especially for beginners. In reality, studies consistently show that over the long term, the vast majority of actively managed funds fail to beat their benchmark index, like the S&P 500 after fees. Warren Buffett himself famously bet a hedge fund manager that an S&P 500 index fund would outperform a basket of hedge funds over 10 years, and Buffett won. The myth that you need to be an expert is precisely what index funds dismantle, offering a path to wealth for everyone. But what kind of index funds should you even consider? Index funds come in various flavors, each tracking a different part of the market. The most popular for beginners is an S&P 500 index fund, which gives you exposure to the largest U.S. companies. Examples include VO from Vanguard, IVV from iShares, or SPY from State Street. You can also find total U.S. stock market index funds, like VTI or IQOT, which include small and mid-cap companies in addition to large ones, offering even broader diversification. For international exposure, there are total international stock market index funds, like VXUS or IXUS. While most beginners start with U.S. market funds, understanding these different types helps you build a more robust portfolio. But where do you actually buy these funds? And what's the difference between an ETF and a mutual fund? When you hear index fund, it often refers to an exchange-traded fund, or ETF, or a traditional mutual fund. Both aim to track an index, but they have key differences. ETFs trade like stocks throughout the day on an exchange. You can buy 1 share or 1,000 shares whenever the market is open. Mutual funds, on the other hand, are priced only once a day after the market closes. You invest a dollar amount, and you receive shares based on that day's closing price. For beginners, ETFs are often preferred because they typically have lower minimum investment requirements. You could buy just 1 share, often under $300 for an S&P 500 ETF. Mutual funds might require a minimum investment of $1,000 or $3,000. Knowing this difference is crucial for getting started, but how do you actually buy them? Buying index funds is easier than you might think. First, you need to open a brokerage account. Popular U.S. platforms include Vanguard, Fidelity, and Charles Schwab. These firms offer their own low-cost index funds and ETFs. Once your account is open and funded, you simply search for the specific index fund or ETF you want. For example, if you're looking for an S&P 500 ETF, you might search for VOO, Vanguard S&P 500 ETF, or iShares Core S&P 500 ETF. Then, you place a buy order for the number of shares or the dollar amount you wish to invest. It's often best to set up recurring automatic investments, maybe $100 or $200 every 2 weeks, to take advantage of dollar cost averaging. But what exactly is dollar cost averaging and why is it so powerful? Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of market fluctuations. For instance, you might decide to invest $200 every month into an S&P 500 index fund. When the market is down, your $200 buys more shares at a lower price. When the market is up, your $200 buys fewer shares at a higher price. Over time, this averages out your purchase price, reducing the risk of buying all your shares at a market peak. It takes the emotion out of investing and prevents you from trying to time the market, which is nearly impossible even for professionals. This consistent, disciplined approach is a cornerstone of successful long-term investing. But what happens if you try to do the opposite? Here's a common mistake that quietly costs beginners thousands, trying to time the market. Imagine you start investing $10,000 in an S&P 500 index fund. A few months later, the market dips by 15%, and you panic, selling your shares to avoid further losses. You wait on the sidelines, convinced the market will drop further. But then, the market recovers quickly, and you miss out on the rebound. By the time you feel safe enough to reinvest, the market is higher than when you originally sold. This buy high, sell low cycle is a guaranteed way to erode your wealth. The best strategy with index funds is usually to invest consistently and stay invested, ignoring short-term volatility. But how much can you realistically expect to make? Let's look at some realistic growth potential. The S&P 500 has historically returned an average of about 10 to 12% per year over long periods, though past performance doesn't guarantee future results. Let's use a conservative 8% average annual return. If you start investing $300 a month into an S&P 500 index fund at age 25, by age 65, 40 years later, you could have over $932,000. That's nearly $1 million from investing less than the cost of many car payments. Even starting later, say at 35 with $400 a month, you could still accumulate over $597,000 by 65. The magic of compound interest, combined with low-cost index funds, makes these numbers achievable for almost anyone. But what are the crucial next steps? Your first concrete step is to choose a reputable brokerage firm like Vanguard, Fidelity, or Charles Schwab and open an investment account. For most beginners, a Roth IRA is an excellent choice if you're eligible, as your growth and withdrawals in retirement are tax-free. If you have a 401k through your employer, check if they offer low-cost S&P 500 or total market index funds as options. Once your account is set up, fund it, and then choose a broad market index ETF or mutual fund. An S&P 500 fund is a great starting point. Finally, set up automatic, recurring investments. Consistency is more important than timing the market. Start small if you need to, but start today. This simple framework is the bedrock of long-term wealth building. But there's one key takeaway to remember. Index funds offer a remarkably simple, low-cost, and effective way for beginners to invest in the stock market and build substantial wealth over the long term. By diversifying across hundreds of companies and minimizing fees, you tap into the growth of the entire economy without needing to be an investment expert. The single biggest takeaway is to start early, invest consistently, and stay invested. It's about time in the market, not timing the market. If you found this guide helpful for demystifying index funds, please consider subscribing for more straightforward personal finance advice.